Our next speaker is Senior Vice President and Chief Credit Officer for Single Family Business, Terri Merlino. Terri, you may begin.
Thanks, Cass. Let's go to the first slide. So for those of you who have participated in Investor Day in prior years, you will notice that the key components of our credit risk management framework that I have represented here remains relatively constant. The last year has demonstrated more than ever the strength of our credit risk framework. This framework has worked well and supports strong credit risk management in stable times, but we also found that it worked equally well in times of crisis, like we have experienced during the pandemic. We did make one improvement in 2020, and that was to move our quality assurance function to the second line of defense. This allowed us to provide a more independent and therefore objective view of how our quality control process is working. So depending upon what's happening in the marketplace, the lending environment, different areas of this framework may play a more significant role. But know that the loans that we purchased over the last year have benefited from this strong credit risk management framework, and it will continue to support our current and future production. Let's turn to the next slide. So here you see the 3 C's of managing mortgage credit risk. Credit, which sometimes you'll hear referred to as character. We also have capacity, and collateral are the other 2 C's. Credit refers to the borrower's willingness to pay. Some of the factors that can determine credit and that willingness to repay is their credit score, whether or not there have been any foreclosures, bankruptcies, mortgage delinquencies, repossessions, collections, etc. One thing that's worth noting in the current environment is that the CARES Act governs how furnishers must report to the credit reporting agencies. The Act requires that furnishers must continue to report the account status as current, provided the account was not already in a delinquent status prior to forbearance. So if they were current at the beginning of a forbearance period, they will continue to be reported as current. This reporting approach, placing borrowers in a temporary deferred payment plan on a forbearance, along with reporting the account status as current, will permanently ensure that a borrower's FICO score will not be impacted by late payments related to the effects of the COVID-19 pandemic. Conversely, if they were delinquent at the beginning of that forbearance period, they will continue to be shown as delinquent. So another thing to point out as far as the treatment of borrowers who are seeking a new mortgage that did go into forbearance, currently, we do require that there are 3 consecutive timely payments before the note date for those borrowers who are in a repayment plan, a deferral, or any other loss mitigation program. So they have to demonstrate that they still have, that they have now regained that ability and that willingness to repay by making 3 payments as they come out of that forbearance plan. So let's talk about capacity, the second of the C's. Capacity refers to the borrower's ability to repay the loan. Factors that can determine their capacity is their monthly housing expense to income ratio. So what's the amount of income that they make, the amount of debt payments that they have. So again, that'll impact the debt payment to income ratio. If the borrower is salaried or if they're self-employed, what kind of cash reserves they may have, and then other loan characteristics. One of the things to note as part of our capacity assessment within our proprietary automated underwriting system, known as Loan Product Advisor, we are able to leverage our asset income modeler, which is known as AIM. AIM automates the process of assessing a borrower's assets and income by receiving data directly from an independent third party, which basically moves that QC process up front. We're able to leverage asset account and transaction data, tax return data, employer data, so that we're able to get that right up front during that risk assessment process. Using this data, AIM assesses whether there are sufficient assets and income for the transaction. So in so doing, AIM removes subjectivity and manual errors because we're able to apply a consistent set of rules to all the loans that are assessed by AIM. AIM also reduces fraud that can be associated with traditional paper documentation, because it's all data that we're receiving directly from a third party. As we've done analysis, we've determined that when using AIM, it solves 97% of the highest ranked income defects that we see in that post-funding QC process. So from a lender's perspective, these tools, they drive efficiencies in their loan manufacturing. But if you think about everything that I just shared as far as the benefits of AIM, the real value of these tools for Freddie Mac is what they do and what they bring to our credit risk management. Number one, through AIM, we are typically obtaining the income and the asset information directly from a trusted third-party source. So therefore, we know that the information is reliable. Number two, through AIM, we are able to take that reliable data and we can calculate the income that's available to service the loan. This produces more accurate and consistent income information that we can then use in our risk assessment. You know, with all the unprecedented origination volume that we've seen over the last year, one of the benefits that we have experienced is that we are seeing an uptick in interest in the tool adoption by our lenders as they can see the value of the efficiencies. We've seen the utilization of AIM products over the last year increase by greater than 50% for the loan in the loan application process during 2020. So we went from 12% of our loan applications to 18% leveraging AIM. So these strong results evidence that our lenders really do see the value in the efficiencies that the tool provides in the current environment. We're working hard to support that adoption because we see the value of the improved risk management. Increasing adoption of our existing AIM tools remains a top priority for us. Lender and service provider integrations are being analyzed to determine areas of focus to sustainably increase the adoption of our risk tools for all of the reasons that I already shared in both the asset and the income space. So let's go on to the last C, which is collateral. Collateral refers to the property that is being used to secure the loan. Factors that can determine the risk associated with collateral can be the borrower's total equity or the down payment if they're purchasing a property. What is the property type? For instance, is it a one unit? Is it a condominium? And then what is the property use? Is it going to be a primary residence, a second home, an investment property? We have three tools that we use to assist in this space. These include our loan advisor automated collateral evaluator, so that's ACE. ACE leverages proprietary models, historical data, as well as public records, and it allows lenders to originate eligible loans without a traditional appraisal. Our loan collateral advisor analyzes appraisal reports and provides Freddie Mac's view of the appraisal quality and the risk. So provides that view to the lenders as they leverage that particular tool. And then the last tool, Condo Project Advisor, that allows clients to easily request pre-funding, pre-closing at the unit level project waiver requests for very specific eligibility criteria that we have identified. Michael Bradley will be sharing more about our collateral tools when he goes over some of the modeling activities that happen in that space. These three C's come together in our automated underwriting risk assessment platform, which includes Loan Product Advisor or LPA. And LPA is generally used in the origination cycle of the loan to provide that automated risk assessment, as well as providing specific messaging to lenders regarding their confirmation of the details of the loan. For instance, what documentation they need to gather in order to support all of the information that they're collecting from the borrower. AIM and ACE are part of that risk assessment, and that's done in LPA. Loan Quality Advisor, which you also see represented here, is a risk and eligibility assessment similar to LPA, but it evaluates the loan data to help lenders determine if a loan is eligible for sale to Freddie Mac, and generally that particular tool is used near or after closing for the necessary risk assessment to determine eligibility for sale to Freddie Mac. So let's go on to the next slide. In 2019, we announced that we were addressing a long-standing approach whereby we would purchase loans that were evaluated by automated underwriting systems, primarily Fannie Mae's DU. So we would permit the purchase of loans even if they weren't evaluated by one of our risk assessment tools. During 2020, we continued to work with clients to implement our tools. We wanted to make sure that every loan that we purchase had been assessed by one of the risk assessment tools that I mentioned earlier, Loan Product Advisor or Loan Quality Advisor. As you can imagine, getting lenders to adopt and implement these tools, it did require some IT changes with their systems in order to support LPA or LQA. We're really proud of the progress that we've made on this front. At the start of 2019, approximately 65% of the loans that we purchased had been assessed by our tools. With December 2020, with those fundings, we have reached 99%. So we went from 65% to 99% are being assessed by one of our tools, either LPA or LQA. Buying loans that are assessed through our tools was a critical step to ensure that we completely control our destiny with our own credit risk assessment with respect to our loan purchases. So let's go on to the next slide. As you can see here, as far as the volume that has come in over time, 2020 ended at $1.1 trillion of volume. Our 2021 forecast is about over 900 billion. It's about 10% down year over year, with most of the expected decline coming from refinances as we start to see loans that can be refinanced have already been refinanced as interest rates may tick up a little bit. And other thing to share, to take a look at, you can see the quality of our portfolio remains incredibly strong, with the loans purchased during 2020 having strong credit characteristics. You can see that the average LTV has actually moved down and FICOs have improved as well. You may be aware that in January 2021, the U.S. Treasury amended our 2008 Preferred Stock Purchase Agreement, known as the PSPA. One of the things that I did want to point out, and I'll talk about the PSPA in a little bit more detail in a few minutes. The PSPA does establish certain new covenants, which places certain restrictions on what our single-family loan acquisitions can be. So we'll cover that in a little bit more detail. It ties to second homes, investment properties, as well as QM loans. So we do expect that these requirements that I'll cover in a few minutes will have some impact on our loan purchases as we look out to the future. So let's go to the next slide. The next couple of slides give you an update on the temporary policies that we put in place last year to address the market realities that we saw unfolding during the pandemic. During the very early stages of this crisis, the emphasis was most heavily placed on credit policy. We needed to respond to the market and identifying areas where we could provide prudent flexibility to allow lenders to continue to offer financing while properly assessing the credit risk associated with borrowers as well as the loan characteristics. We needed the ability to respond quickly, but do so in a way that continued to support sustainable lending. In some instances, this represented expanding our guidelines via certain flexibilities, but in others, it actually required some contraction to make sure that we had that prudent risk management to support the sustainable lending. All of the temporary policy actions that were put in place to ensure that prudent risk management, those continue to stay in place in this time, and I'll cover those in a minute. But meanwhile, the flexibilities that we announced during 2020, they basically fall into two buckets, and I wanted to give you an update on where we are with all of this. The first bucket, you'll notice that we provided notice to lenders that these will be discontinued. And then we have a second bucket where we've actually moved items to the guide, and they've become a permanent part of our requirements within our selling guide. The flexibilities where we have provided notice that they will be discontinued include flexibilities regarding the appraisal process, as well as our 10-day pre-closing verification. That actually falls into two pieces. Some elements of the 10-day pre-closing verification moved permanently into the guide, and then other aspects of it were temporary in nature and are being discontinued. And the part that went into the guide is to allow an email to be used. Previously, we only permitted a phone conversation to conduct that pre-closing verification. Now, as long as that email can be achieved through an independent source, will allow an email to be used to verify the borrower's employment status 10 days prior to closing. We also had expanded LTVs for condo project reviews, and we are discontinuing that as well. And then the last item, we had temporarily updated our mortgage eligibility requirements in April 2020. That allowed sellers to deliver certain mortgages that were in forbearance. There were some liquidity challenges at that point in time. Otherwise, those normally would not be eligible for sale under the guide. We did discontinue this temporary eligibility in the fourth quarter of 2020 as we saw that need disappear, and there was really very, very little low volume, quite frankly, over the entire time that it was outstanding. And then lastly, as I mentioned, we moved a few of the flexibilities that we had identified at the onset of the crisis to our guide. We expanded the eligibility of our automated collateral evaluation, ACE, that I talked about earlier, those appraisal waivers. We had expanded that to include certain cash outs and no cash out refinance transactions. That section has been permanently updated in the guide. And then we also updated our rep and warrant framework, allowing a mortgage that was in forbearance status. It could still qualify for the relief of the enforcement of the rep and warrant, as long as it met all of the standard payment history requirements that are part of the rep and warrant framework. So now let's go to the next slide and talk about, just remind everyone what were the temporary policies that we put in place around greater risk management. These items were to address credit quality, safety and soundness issues, as well as making sure that we could better assess the borrower's income, employment, and assets during the pandemic. Some examples of these, we wanted to make sure that we could confirm a borrower's employment. That's definitely been very critical, as it has been very fluid business environment over the last year, seeing borrowers be furloughed, their hours reduced. Businesses may have been temporarily closed, or they may have reduced their services. So as a result of all of those concerns, we do require evidence that a business remains open and operating for self-employed borrowers, but we require that to be within 10 days of the note date. So it's a much tighter time frame than we would typically apply. And then we also continue to require the evidence of stability of the income to make sure that self-employed business is operating as expected. There we're requiring copies of things like executed contracts or signed invoices. So that gives us a good idea of the business still being in force, in operation. As far as confirming the continuance and the stability of the income, we saw as borrowers have been furloughed or saw their hours reduced, we do require additional due diligence to make sure that their stability of their income closer to the note date. So we move that from 120 days, and we're still requiring that verification to occur within 60 days of the note date. So that tighter time frame is still in place. We're also requiring that the borrower's existing mortgage to be either current and that the borrower has made at least 3 consecutive payments prior to the note date, prior to them getting a new mortgage. I mentioned that earlier. With respect to assets, we saw a very volatile stock market over the last year. So one of the things that we did put in place is that stock options, mutual funds, we continue to require those. We want to see that there has been evidence of that liquidation, and any instance where we need those funds in order for to cover the down payment or to cover closing payment, to cover closing costs. So we want to make sure that that has been liquidated and those funds are available to cover both of those items. And then also, in addition to all of the credit policy actions that I've addressed, we've continued to closely monitor the limits, exposures, and financial condition of our seller servicers, and that'll be covered by Katie Shalinski. We go on to the next slide. Let's talk a little bit about the PSPA, or the Preferred Stock Purchase Agreement. So as I mentioned earlier, in January 2021, the U.S. Treasury amended the 2008 PSPA. In that amendment, it established some new covenants which placed additional restrictions on our single-family loan acquisitions. So first, the first item, in order to provide more equitable access to the secondary market, to make sure that we're providing that to small lender protections, there are a couple of items that were addressed. The first one is there are restrictions regarding pricing and terms for acquisition of single-family loans based on, so there restrictions regarding pricing and terms for acquisition of single-family loans based on size, charter type, volume of business, or seller of the loan are not permitted. In addition, we're required to offer the cash window for loan purchases with non-discriminatory pricing. And then beginning no later than January 1st, 2022, we have a limit on the volume of loans that we can purchase through the cash window. That has been set at $1.5 billion per lender, and that covers the prior 4 quarters on a look-back period, starting January 1st, 2022. And then naturally, we need to comply with any directives, regulations, restrictions, et cetera, that FHFA has placed on us. With respect to the acquisition of single-family loans, we do have some restrictions there under the amended PSPA. The first one, we're limited to the amount of mortgages we can purchase that have layered risk. It's a maximum of 6% of purchase money mortgages and 3% of refinance mortgages. The layered risk that we're talking about here, the loans can, if they have 2 or more of the following characteristics at origination, is going to be limited to that 6% or limited to the 3% related to purchase or refinance mortgages. The characteristics are combined LTV ratio greater than 90%, a DTI ratio greater than 45%, or FICO or an equivalent credit score less than 680. We've also been limited in the amount of single-family mortgage loans that are secured by either second homes or investment properties. These are limited to the 7% of single-family mortgage acquisitions. Note that the purchase of loans with layered risk, as well as the purchase of investment properties or second homes, those were effective immediately. So as soon as the PSPA was issued, it was effective immediately, and those both are calculated over the preceding 52-week period on a look-back basis, and those are calculated based upon the unpaid principal balance. And then the last item that we have here is by July 1st, we must implement a program that's reasonably designed to ensure that all of the single-family mortgages that we purchase, they are a qualified mortgage. So going to the last slide. So we continue to assess all of the effects of the new purchase agreement covenants on our business, and know that we are developing all the related business processes, controls, quality control, et cetera, including those with respect to monitoring and reporting. As we have communicated in our 10K and our 10Q, we have been compliant with both the investment property requirements, because recall those were effective immediately. The second home, the investment properties as of January, and we have taken steps to help ensure that we remain in compliance. You'll see here we've made a number of announcements to address the PSPA loan acquisition requirements, specifically as it relates to the acquisition of the mortgages secured by investment properties and second homes. And we've also had a number of bulletins regarding the acquisition of qualified mortgages. So we continue to evaluate any additional actions that we may need to take in order to continue to stay compliant. As we navigate through 2021, we'll need to balance these PSPA requirements as well as our regulatory scorecard goals to ensure the safety and soundness that we follow. And with that, wraps up my prepared remarks. Thank you very much for your time today.